Hello, so this video is all about the accounting worksheet. So we are going to cover some vocab, sections of the worksheet, an example worksheet. We're going to talk about net income and how that is different from net loss. And we're also going to talk about handling errors. So here we go, starting with vocab on page 1. Why do accountants analyze, summarize, and report all this info? Well, the answer is so that business owners, managers, and investors can make informed decisions. So it's really important that we follow these accounting concepts. The first one is called consistent reporting. This means that the same accounting procedures are followed in the same way each accounting period. It's so you can compare apples to apples. A fiscal period is defined as the length of time for which a business summarizes and reports financial info, also known as an accounting period. It could be a month, it could be a quarter, which is 3 months, it could be a year. It just depends on what works best for the business, and the business gets to decide. So the accounting concept accounting period cycle states that when changes in financial info are reported for a specific period of time in the form of financial statements. Again, the length of time is chosen by the business. 1 year is common, can begin on any date, but usually the first of a month, usually ends at a slow time of year, not always the end of the calendar year, December 31st, but typically the slow time of year for that particular industry or that particular business. Now, the definition of worksheet is a columnar accounting form used to summarize the general ledger info needed to prepare financial statements. And accountants use these worksheets for 4 reasons. One is to summarize general ledger account balances to prove that debits equal credits. A second is to plan needed changes to general ledger accounts to bring account balances up to date. The third is to separate general ledger account balances according to financial statements. And the fourth is to calculate the amount of net income or net loss for a fiscal period. Moving on to page 2, this is all about the sections of the worksheet. So there are 5 total sections. 1 is the heading, 2 is the trial balance, 3 are adjustments, 4 you extend the account balances, and then 5 is net income or net loss. So a little bit more info on the trial balance. It is defined as a proof of the equality of debits and credits in a general ledger. And we already know that for every transaction, debits must equal credits. And so this is just confirmation that your overall debits equal your overall credits. So in the trial balance section, all account titles are listed even if the balance is 0, and info is taken from the general ledger and accounts are in the same order as the general ledger. The heading is at the top of the worksheet. The trial balance section includes a column for account title and then a debit and a credit section for trial balance to be calculated. Adjustments are another debit and credit section. And then when you extend the account balances over, you have 2 sections for debits and credits. One falls under income statement, the other falls under balance sheet. And down at the bottom, you calculate net income or net loss. So the definition of adjustments are changes recorded on a worksheet to update general ledger accounts. Net income is when total revenue is greater than total expenses, and net loss is the opposite. It's when total expenses are greater than total revenue. Moving on to an example, this is found on pages 3, 4, 5, and 6. On page 3, we have what the overall worksheet looks like, and we're going to focus on the trial balance and the heading for this page. So preparing a heading, first is the business name. Second is the title of whatever document you're preparing, and in this case, it's worksheet. Third is the date, and the date is for a fiscal period. So instead of just saying whatever the date is, you say the words for month ended or for year ended, and then you include the month, the date, and the year. So here's an example. Then you prepare the trial balance by writing the general ledger account titles in order. Then you fill the balances in the correct column, debit or credit, leaving any blank that do not have a balance. Then you total the debit column, then the credit column, and then you check to see if they match. So this is what this looks like. We've got cash, that's our very first account in our general ledger, followed by an accounts receivable account. Then we've got all the rest of the asset accounts. Then we have a liability account, accounts payable on row 5. Then we move into our owner's equity account, starting with capital, then drawing. Then there's an account called income summary, which we haven't talked about yet. And then we have our sales and our expenses. Next step is to fill those balances in based on what they are in the ledger. And so you'll see that these first 4 are all debit balances. You need to make sure that you put it in the normal balance side. And so obviously all of our assets, our normal balance side is debit. And then once we get to our liability, we need to put the balance in the credit section because the normal balance side for accounts payable is credit. Then for our capital account, the normal balance side is credit. Drawing, it is a debit, so you're back to the debit side. There is nothing going on in the income summary account, so you don't put anything there. So make sure you skip a line if you need to. Then sales is a credit balance, and our expenses are debit balances, but only one of our expense accounts has a balance right now. So for insurance expense and supplies expense, you leave those blank, but you do include them. At the bottom, you put a single line to show that you need to do some math there. Then you add up all of those debits, you get your answer, and then you add up all of those credits and you get your answer, and hopefully they match. If they do, you put a double line below them and it verifies it. It shows it as correct. My first year teaching accounting, a student said it's kind of like a really long equal sign, and it is kind of like a long equal sign. So let that equal sign confirm that it is verified and it was checked and it does in fact equal. Over here on the bottom right, it tells us that there's more about errors on page 7 and 8. Trial balance is complete once it is confirmed that they match. Once this is confirmed, you can move on. That should say move on. You can move on to adjustments. If it doesn't match, that means there's a mistake, and that means you need to go back and find what the mistake is. If it does match, yay, that means that you can move on. Now we're moving on to the adjustment section. So in order to give accurate info on financial statements, some general ledger accounts must be brought up to date at the end of the fiscal period. So down at the bottom on the left, it says a debit to the supplies account is made each time supplies are bought. However, recording an expense each time a pencil is used is impractical. So the balance of the supplies account is the value of all the supplies bought until the adjustment is made here on the worksheet. Up in the top right, matching expenses with revenue is an accounting concept that states revenue from business activities and expenses associated with earning that revenue are recorded in the same accounting period. For example, if you go to Sam's Club or Costco and you buy toilet paper in bulk, you might buy 50 rolls. Well, you don't use all 50 of those rolls in a month. And so you only account for the number of rolls that you used in that month. If they didn't do it that way, it might look like you lost money one month just because you bought a bunch of supplies. And that doesn't really make sense. So this matching revenue with expenses helps solve that problem. All right, in our T accounts here, before the adjustment, the 2 accounts that we're focused on here are supplies and then supplies expense, which we haven't put anything in yet, but this is where we do that. So supplies we know is an asset and it increases on the debit side. And we know that along the way, when we purchase supplies, in this example, we purchased $1,100 worth of supplies, and there's nothing going on in supplies expense yet. In the middle at the bottom there, inventory is taken. The amount of supplies on hand is subtracted from the beginning balance to get the adjustment. In other words, and some of you may have done this on the job before, where you count up what you have. That's called inventory. And when you count up what you have, you can look at the numbers from where you started, count up what you have, and then the difference between those two, that's what you used. And so again, that's called inventory. So after adjustments on our T accounts here, again, supplies and supplies expense are the accounts that are impacted. Our supplies has to be decreased because we used some of those, and we know that assets decrease on the credit side. Supplies expense, as all expenses do, increase on the debit side. Now, this gets confusing, but we know that overall owner's equity is decreased when we have an expense. And so, overall owner's equity, when we've got reasons to smile, it's a credit, and when we've got reasons to frown, it is a debit. So our supplies expense does increase on the debit side, but it decreases overall owner's equity. So the amount we're entering here is that $50 because what we did was we took our beginning amount, which was 1,100, and then we counted up. We took inventory and we realized that we still have $1,050 of supplies on hand. So we only used $50 worth of supplies, and that is our adjustment. Over here in our adjustments columns, we need to enter this. First, what we do is we decrease our supplies account by $50. And we know over in the trial balance column, we have a debit of 1,100. And so if we're going to decrease an asset, that's going to be a credit. So we put our amount in the credit column of the adjustments, and we put a little A in parentheses to show that it matches with this expense. And in supplies expense, again, over in our little T accounts, it is a debit. And so we record it as a debit in the adjustments column, and we attach it to the other one with that little A in parentheses. And insurance is done the exact same way. So we have $600 worth of insurance, and we realized that we spent $100 worth, or we used $100 worth of that insurance during this fiscal period. And so we decrease it with a credit in the adjustments for prepaid insurance. And then we have the matching debit in insurance expense of $100. So we put a line to show that we need to do some math, and then we add up the debit, and it's 150. We add up the credits, and it's 150. And so they are, in fact, in balance. We put that equal sign, that long equal sign there with the double lines to show that it is verified that they are matching. If they don't match, you need to go back and find your mistake. Again, more on finding mistakes coming up. But if they do match, yay, then you can move on. On page 5, we're going to start with the definitions of income statement and balance sheet. This page is all about extending those balances all the way across. So an income statement is a financial statement showing the revenue and expenses for a fiscal period. And a balance sheet is also a financial statement that reports assets, liabilities, and owner's equity on a specific date. So if you look over on the top left, you'll see that the balance sheet accounts are those accounts that fall under the accounting equation. So assets equal liabilities plus owner's equity. The income statement accounts are all those accounts that show money coming in and money going out. These fall under owner's equity, but they're specific to income. So sales is typically money coming in, and then the expense accounts are all the examples of accounts that you would use for money going out. You'll notice over here the big X's in the middle of the worksheet. That's showing us that our balance sheet accounts do not appear anywhere in the income statement columns. And the same goes for our income statement accounts in the balance sheet section. So you won't write anything in those sections. What we're going to do is we're going to draw a line. You're going to draw a line all the way across to separate those accounts. So cash, accounts receivable, supplies, and prepaid insurance, those are all assets. Accounts payable is our liability here. Owner capital and owner drawing, of course, our owner's equity accounts, those are all represented. All of those accounts are represented in the balance sheet. Then below that, we have this account called income summary that we haven't really talked much about yet, but that is where the income statement accounts start. So you'll see the sales and the expenses accounts there. So draw a line all the way across between rows 7 and 8. Okay, so then we look at the first row, and we're going to follow that first row all the way across. So we look at cash, and we see that it is a debit of $500 in the trial balance column. So then we follow that arrow all the way across. Because it is a balance sheet account, it is not included anywhere in the income statement column. So we go all the way down, and we record it as a debit in the balance sheet columns. We do the same thing for accounts receivable. This is a $200 debit, and so it's a $200 debit in the balance sheet. We literally just copy it. But then in row 3, we look at supplies, and we see that it is a debit of $1,100. And then as we follow it all the way across, we see that there is a credit in the adjustments column. Now, keep in mind why our adjustments are done. So we bought $1,100 worth of supplies. That's what we have at the beginning. Then we realized that we used $50 of that. And so now we need to subtract that. So we take the 1,100 minus 50, and then we record that as 1,050 in the debit column of the balance sheet account because it is an asset and the normal balance side is a debit. Next up, we have prepaid insurance, and the same thing happens here. So we start with $600. As we follow it along, we see there's an adjustment of $100, and that means our balance in the balance sheet column is going to be 500. 600 minus 100 is 500. Next, we follow our accounts payable account, and it is a credit. So we go ahead and follow it all the way down, and it will be a credit in the balance sheet column. Same thing with capital. We follow that all the way across, and it's $2,000 in the credit column. And then our drawing is $100 in the debit column. So we pay attention to debits and credits, make any adjustments as you go across the sheet. And other than that, you just copy it. Moving on to the income statement accounts, nothing is happening in income summary, so you just leave that blank all the way across. In the sales row, you'll see that there is a credit in the trial balance column, so we carry that all the way over to the income statement credit column. Then people get mixed up oftentimes with expenses. You got to pay attention to which column it's in because there are some balances in the trial balance and others in the adjustment. So pay attention to debits and credits. So we look at insurance expense. Nothing's going on in trial balance, but there is a debit in the adjustment section. So when you carry that over to the income statement, it will be a debit. So it's $100 debit for insurance expense. Rent expense has a debit of $600 and nothing going on in the adjustments. So it is a debit in the income statement section. And then supplies expense, nothing in trial balance, but in adjustments, we have $50. So it is a debit of $50 in the income statement section. And if you're in doubt, just remember normal balance sides. Okay, so now we do a single line to show that we need to do some math. And now we add up the debits in the income statement section, and we get 750. We add up the credit in the income statement section. It's just one number, so you just drop it down. It's 800. And sometimes students stress out when these don't match, but it's okay because they're not gonna match yet. So then add up the debit in the balance sheet column, and you get 2,350. Add up the credits, you get 2,300. And again, don't worry because they're not going to match yet. Okay, page 6. This is the end of our example worksheet here. So in the top right-hand corner, we consider what net income does to overall owner's equity. It increases it. Therefore, it is a credit. So we're going to keep that in mind as we go here. Okay, so we are in the income statement columns, and what we want to do is we want to look at those totals, and we want to subtract the debit from the credit. So when you think about what's actually going on here, that $800, if you follow it all the way across, there's a text bubble in the way there, but that $800 is sales. So that's all the money we brought in. Then the 750, those are all of our expenses that were added up. So that's all the money going out. So we take the 800 minus the 750. So you take the credit minus the debit. If it is a positive number, it is net income. And over there in the account title column, you write net income if it's a positive number. Then you write the answer in the debit column of the income statement section, just below the total of those expense accounts. So just under the 750, you write $50. And then to match that debit, over in the credit column of the balance sheet, you also write that $50. It's the same calculation, it's just carried over. And if you're thinking about what's going on here, think about what it does to overall owner's equity. Look in the balance sheet, that little bubble at the top that we talked about. It is increasing overall owner's equity, so it is a credit. Now you add again. So you take that 750 plus 50 and you get 800. You drop that 800 down. Now they should match. 800 debit, 800 credit in our income statement column. That's good news. Same thing for the balance sheet columns. You take the debit and you drop it down, and it's 2,350. And then you take the credit and you add those up and you drop it down. So 2,300 plus 50 is 2,350. And again, the debit and credit do now match in the balance sheet section. So you put those double lines to verify that they have been checked and they do in fact match. And now they should match. Moving on to page 7, we're going to talk about net income versus net loss. Net income is when total revenue is greater than total expenses. So, what do you imagine a business owner's reaction would be when net income is calculated? They probably cheer, they probably jump for joy. So, you can see our little silhouette there of arms extended. It's a very happy, like wide stance for cheering. And that's a little visual you can think of when you think about what columns they go in. They go in the outside columns because you're cheering with big arms. So you can think of it that way. You can also think of what it does to overall owner's equity. And in the balance sheet columns, it is increasing overall owner's equity. So it's going to be a credit. On the other hand, net loss is when total expenses are greater than total revenue. So if you imagine what a business owner would look like when they realize they have net loss, it might be a more shoulder slumped stance, more of like a downward inward kind of stance. You can see our little silhouette guy there. So just a kind of visual that has helped accounting students in the past, but that's a reminder that net loss is recorded on the inside columns. And if you consider what net loss does to overall owner's equity, it decreases it. So therefore, in the balance sheet columns, it's going to be a debit. Calculating net loss works the same way. You take the credit balance of the income statement columns and subtract the debit balance. If it is a negative number, that means it's net loss. You record it below the total of the income statement credit column and you extend the balance to the balance sheet debit column. And then instead of writing the words net income, of course, you write the words net loss on the corresponding row in the account titles column. Okay, to prevent errors, as always in accounting, you want to work carefully. You want to check your work at each step. You want to double check your math with a calculator. And when an error is discovered, you want to fix it because if you don't fix it, it's just going to follow you and you're going to have to fix more later. So make sure that you're following those good accounting practices. However, if you do come across an error, when you're correcting errors on a worksheet, you erase and rewrite. It is not a permanent record. This is just like it sounds. It is a worksheet for accountants to work out the different numbers. And so journals and ledgers, you don't erase, but you cross out because those are permanent records. But this worksheet is what it says. It's a worksheet for accountants to figure it out. So if you need to erase and fix your errors, you can. And here we are. Our last page is handling errors. So checking for errors in the worksheet consists of these things. For any of the following, make corrections and add the columns again. In the trial balance columns, you want to ask, have all ledger account balances been copied correctly? Also, are there any typical calculation errors? In the adjustments columns, you want to ask yourself, do debits equal credits for each one? And is the amount for each adjustment correct? Not the amount on hand, but the adjusted amount. In the income statement columns, you want to ask, has each amount been copied and extended correctly? Also, does it belong in the income statement column? Balance sheet columns, you want to ask, has each amount been copied and extended correctly? Also, does it belong in the balance sheet column? So sometimes income statement and balance sheet columns get each other's information. So you got to make sure it should be in those columns. And then lastly, for net income and net loss, has it been calculated correctly? Has it been recorded in the correct columns? So if a pair of worksheet columns doesn't balance and an error can't be found on the worksheet, you want to look for an error in posting from the journal to the ledger accounts. If an error is found, you want to make the correction and then follow that correction through the worksheet. As each entry is verified, a check mark should be put next to it, indicating that the item has been checked. And checking journal entry errors consists of these questions. Do debits equal credits in each entry? Is each entry amount recorded in the correct column, meaning debit or credit? Is info in the account title column correct for each entry? Are all the journal amount column totals correct? Does the sum of debit column totals equal the sum of credit column totals? And have all transactions been recorded? So if you just heard my child in the background, I left it in because it was the end of the page, and I also just thought it was kind of funny. So I hope you think it's funny too. But here we are at the end of the accounting worksheet visual notes. We have covered vocabulary. We have talked about sections of the worksheet. We've gone over an example. We talked about net income versus net loss, and we also talked about handling errors. So at this point, you can go back and fill in any details in the margins, color it, do whatever you'd like with it. Hopefully you find it helpful, and thanks for watching.